from time to time, you may see me look down at my phone just to make sure that we're able to transmit information out. So I'd like to welcome Tom. Tom, are you there?
I'm here, Mike. Very nice to be here with you and your customers.
Thank you very much. As before, the audience members can participate by using the control box on the right-hand side, which is the control panel. There will be an opportunity to pose questions and answers later on during the webinar, and we'd like to welcome all of the folks that are participating. We have 29 states and 2 countries represented today. Michigan and Georgia are most represented. And we also have clients calling in from California, Indiana, and Virginia. And welcome to the 2 people from overseas. So let's try a question first of all. We'd like to get a sense of how many folks own their own facility and how many are renters. So if you could just use the question box to fill in, just say I'm an owner or I'm a tenant, and we'll see if we can collate those answers. So we're going to get started with the presentation now. So to buy or not to buy, that is the question, with apologies to Shakespeare. Obviously, we want to help everybody get to a situation where their facility looks like the one on the left and not the one on the right. Here are the objectives for today's presentation. We're going to talk about the benefits and the burdens of owning your own facility. We're going to talk about the opportunities and risks involved if you're going to be a tenant, and what factors go into making this decision. There'll be a short discussion on financial and tax considerations, and the meat of the presentation today will be on some case studies down at the bottom of the presentation. Then we'll have time for questions and answers. For some housekeeping items, if people have difficulty with with hearing it through the computer, you can always use the telephone to call in. And I believe that we have provided the phone number 914-614-3221, and the access code is 729-158-703#. So we're going to keep going on here. The next slide is for Tom, and we'd like to, the reason why we've asked Tom to join us is that Store Capital is one of the many investors that Strategic Solutions Group interacts with to help our customers achieve some of their transaction goals. And I'm going to ask Tom to give a quick introduction now on his company and discuss the slide that everybody's able to see. Go ahead, Tom.
Sure, Mike. Hey, thank you very much, and very nice to be speaking to everybody. Very interested in talking more about Store and how we may be able to help your business grow. Our company is by trade a real estate investment trust. So that means we're in the business of acquiring real estate. But what really is our secret sauce and what we really do is provide financing solutions to middle market companies like yourselves. And the reason why we're successful is because our clients continue to thrive and grow, and we continue to open new units and provide flexible financing solutions to our customers as they grow their business. The way we do this is through a methodology called a sale-leaseback and build-to-suit financing, whereby we provide all the capital that you would incur on real estate. And we acquire a facility and we provide you with money to improve it. And if you want to build a new facility, we acquire the dirt and provide you with 100% financing on all the real estate assets. So in a nutshell, that's what we do. Our company has been led by a management team that's taken 3 companies public. We have about $5 billion in assets under management and are traded on the New York Stock Exchange. So you can look us up. Our ticker is STOR. We really focus with smaller operators. We like working with middle market companies where we can develop a relationship with the principals, and we can be a strategic partner in helping them grow their business. And so we do deals from the neighborhood of $500,000 on the low end, all the way up to about $200 million on the high end. We have about 360 customers and over 1,700 properties nationwide. So, you know, really excited to talk more about STOR and how we may be able to help your business grow.
Fantastic. Thank you very much. And for the audience members, SSGA has completed several transactions with the folks at STOR. They range from regional providers in the Northeast to some national providers in the Southwest. We've also completed individual one-site, two-site transactions in various cities, and we're pleased to have them as part of our investment Rolodex. And thank you, Tom, again for joining us today. We will ask that we don't want 100 different people calling Tom and saying, what about my deal? What about this? What about that? We'll give us a call first. We can talk about your situation, and then we'll figure out whether it's Tom or somebody else at STOR that would be an appropriate person to connect with. Okay, so let's get started. So some of this information may seem obvious, but we like to write it down, and you can use this as a reference tool for thinking about your own particular situation. So the benefits of owning your own real estate, equity appreciation is certainly the #1 issue on most people's minds, especially where the economy is right now. Real estate has gone up in value over the last several years. Interest rates are low, and many people believe that owning their own building is a way to build up their own balance sheet. Unfortunately, the benefit of owning your own building is oftentimes can be the flip side for the burden. For example, owning your own real estate means you tie up your cash, and you're not able to have the liquidity if all of your money is tied up in the building. Also, many people don't have millions of dollars in cash, so they need to get financing, and many times the lender will require a personal guarantee. That makes many folks uncomfortable. So the aspect of real estate of being able to build up equity and build up your wealth comes with some costs and burdens. Many people tell us that they want to own the building because they want to control their asset. They don't want a landlord to raise the rent. They want to be able to control what happens in the facility, and this is one of the benefits of owning it. Well, the flip side of that is you might get stuck with it. Let's say it's 25 years from now, and the demographics of the neighborhood have improved, the building's gotten older, and now you're stuck with it. So that flip side is important for folks to think about, not just what's going to happen with the building now, but what's going to happen 25 years from now. I'd like to get Tom's opinion on those top 2 benefits and burdens.
Sure. You know, clearly everybody in our country has been given the notion that owning real estate is kind of your nest egg, and the home ownership mentality, you know, is part of our culture. You know, when you really look at it from a financial perspective, unless your building is in some amazing location where they're going to build a skyscraper or a shopping mall or you know, something just special that is a much higher and better use than a childcare facility, then it really makes sense to have somebody else own your building. And the reason why I say it makes sense is because if you're focused on growing the value of your business and increasing your return on equity, leasing is a much better tool to do that, because it's expensive to own real estate, and real estate itself really doesn't appreciate. Especially if you develop a childcare center and it's always going to be a childcare center, it can really only appreciate at a very low rate versus what you can grow the cash flow of your business at using the money you have trapped in your facility. So if you focus on the financial aspects of ownership of real estate, it's a much better idea to lease than it is to own, because then you're not limited by the amount of money you have on your own balance sheet. You can use somebody else's. So that's really the role that we play.
Thank you. All right. So then many people feel that the tax benefits of owning real estate are very helpful for them, and certainly the depreciation aspect is an important part of sophisticated owners' financial planning. The flip side, of course, of owning the real estate and enjoying the tax benefits is you get to pay for the maintenance and repair. Now, as a tenant, most leases require tenants to make maintenance and repair costs as well, but it's just a different mentality when you're the owner and you've got to replace the roof and you are going to own that building. That's a different aspect versus if you're the tenant on a short-term lease. The next benefit is that you have multiple options at the time of sale of your business. So we do have many clients that own their building, and they are able to explore many different options when it comes time to sell the operating business. They could decide to keep the building as a source of income and a preservation of wealth and enter into a lease with the buyer. They also could decide to sell both the business and the building and capture the liquidity that's been in that property for such a long period of time. The burden and the risk is, at the time you sell your business, you've probably been running it for many years. That building has gotten older since you first acquired it. So the potential is that your building is too old or not functional, and there's a risk that you get stuck with an obsolete building. The final benefit that we see is estate planning and doing a 1031 exchange. The jargon for 1031 exchange refers to a favorable provision of the tax code, which allows an investor to sell a building and defer capital gains tax by reinvesting the proceeds. So many of our clients who own their real estate want to reinvest the proceeds into additional properties, and typically this is part of estate planning. Let's not forget that you still are facing the risk of getting stuck with an old, obsolete building. So to Tom's point, unless your real estate is very well located, then if you're in a secondary location or tertiary location, the appreciation potential of your real estate may be limited. Now, there may be other reasons for you to own the real estate, as shown here. You want to control it, you want current tax benefits, you want multiple options. But if appreciation is your only consideration, then choose wisely.
Right.
Before we move off this slide, Tom, do you have any other remarks?
Yeah, I mean, Mike brought up a lot of really good points there. And back to the tax benefits, when we talk about depreciation, when you calculate depreciation, you're calculating it based upon 60%, say, of the value of your property. And also with leasing, you're able to expense 100% of the rent. So that's a huge benefit that some people often overlook. Is 100% of your rent payment is you can take it as an expense. From a exit perspective, when you're negotiating a sale of your business, when you own the real estate, it's really difficult to maximize the value of your real estate in that situation, because at some point in the process, the buyer becomes more powerful than the seller. So it's always prudent to monetize your real estate and have Mike bring it to buyers before you sell your business, so you can focus on maximizing your proceeds at that point in time. Because you're always going to get a much better cash flow exit multiple on your real estate than you will on your business. So Mike will be able to generate more value and proceeds for you if you sell your real estate prior to you selling your business.
All right, that's a very interesting conversation topic, and would like to focus on that again when we talk about the case study. So let's be sure to get back to that. Okay, now let's talk about the opportunities and risks of leasing a facility. So the opportunity for most folks, especially at the beginning part of your career in the childcare industry, is there's a lower cost of entry. If you are thinking about starting up a business, or you want to grow from 1 site to 2 sites to 3 sites, many times the expense that you'll need to get a facility is limited to a lease payment. And that's certainly a lot lower number than needing an entire down payment in order to get a loan to buy the building. So the number one benefit that we see is a lower cost of entry. The risk of that is you don't own the building and your rent expense could go up. The number 2 idea here is that by having a lower cost of entry, you can put more of your money into the operating business and not in the bricks and mortar. And many of our folks believe that certainly at the beginning of their involvement in the industry, it's better to have that extra money in that working capital to go into the operation of the business. The risk that you face is the rent is due and payable regardless of the performance of your center. So especially for those who are looking to go to a building that's vacant, or you're going to buy somebody else's business that's struggling, that rent is due and payable regardless of the performance of the business. Many times also, a landlord will require the operator to sign a personal guarantee of the lease. If you're not willing to sign that the rent will be paid, you're going to have a hard time convincing a landlord to take on risk on you if you're not willing to put your name on the dotted line. Tom, what are your thoughts on these 2 points?
Yeah, I think that really, if you have a third-party landlord that you don't have an existing relationship with, that you don't plan on growing with, they are only concerned about collecting rent at that one location. And one of the benefits of working with a group like ours that's focused on the relationship rather than just collecting rent at one unit is that if you run into problems, you can come back to us and we can find solutions for those problems because we have a larger relationship that spans across multiple properties. It's inevitable that you're going to have stores that don't perform as well as you would like. And when you're working with a landlord who their only relationship with you is through that one store, it's much more difficult for them to provide you with a solution to get out of that store, or to reduce your rent, or to figure out some way to make it more economically feasible. Whereby if you're working with somebody like us, we can find a way to help you shut down that store and transfer that lease obligation to another store that works. We have much more flexible financing. Just like as a rule of thumb, when you're as large as we are, and when you are specifically focused on providing capital to single-tenant operators, the way we finance ourselves provides you with a lot more flexibility than somebody who goes out and buys property, multi-tenant shopping centers with bank debt or with a CMBS loan. So since we're so large, and since we're set up specifically to help you grow your business, we've been able to negotiate debt terms on our side that provide us with a heck of a lot more flexibility than just your average one-off landlord.
Very good. For those folks that have multiple sites, that is a very valuable flexibility option. And for those folks that have one site and want to grow, it also is helpful to have a sophisticated landlord so that they can develop a relationship. And that's really one of the primary reasons why we like working with the folks at STORE. All right, so the other opportunities here, the flexibility. If you're just a tenant, you may be able to sign a short-term lease, get your business started. You're not tied to that one location. It's not particularly easy to pick up and move your school, but you do have that flexibility if you're just a tenant. The downside, of course, is that if that location becomes very desirable, the landlord may bump your rent, and that may become unsustainable. Down number 4, the use liquidity to expand to other sites. That goes hand in hand with points number 1 and number 2. We find that many of our clientele needs that extra working capital, and they prefer the lower payment of the lease so they could use the working capital. Of course, like I mentioned before, the benefit, if you turn that coin over, the risk, you don't have residual value. You're paying somebody rent, and at the end of the lease term, you might get a thank you, but there's no residual value. And that is something that it needs to be considered when you're looking at your business plan. Finally, the idea that you could sell your business only and not have to find somebody who wants to buy the building, or not find somebody who you want to take a risk on as the tenant. So for example, we have customers who don't own their building and they're just selling their business only. Well, that attracts a few more buyers because there's usually a lower cost of entry. It's not as complicated. Many folks don't want to own the real estate, they want to be a tenant. So by just owning the business, sometimes you're able to make a little bit of a cleaner transaction. There's less moving parts. If you own the business and the real estate, and there are many of you out there that own both, the idea is that you would need to find somebody who could qualify for a loan to buy the building and the business. Or if you want to keep the building, you have to feel comfortable enough that that tenant, that your buyer is going to become your tenant, and you feel comfortable that they'll be able to pay the rent. Otherwise, if they're not able to pay the rent and you still own the building, you're going to need to protect yourself and use your remedies to possibly get involved in legal action and take over that business again. Well, that's right back where you started from. So, Tom, do you have any final thoughts on this slide before we move on?
Yeah, a lot of times people are concerned about having to obtain consent from their landlords when they sell their business, and this is something that we both understand and structure around in advance of executing a transaction. We create certain financial metrics to where if you find a buyer for your business and they meet a certain level of cash flow and a certain leverage profile, you don't even really have to tell us that you're selling your business. So it's called an assignment provision. And when you find a buyer that meets criteria that we negotiate in advance, you can just sell your business to them and just give us a notice that you're selling your business, and tell us who's going to be the new tenant paying us rent. So there's a way that we can address the concern and the risk of consent in advance by a negotiation or at least with you. So we don't want to stand in the way of you exiting your business. You know, if you're selling to somebody who may not be as financially strong as you were when we were doing the transaction, we want to reserve the right to see who they are and underwrite and meet them. But beyond that, if they're as strong as you are when we did the deal, or better, you don't even really have to tell us. You just need to let us know who the new tenant's going to be, and we're going to wish you your best and appreciate your business.
Thank you for that. We have been involved in several several deals where getting the consent of the landlord was a challenge. So before we move to the next slide, we would like to show the results or explain the results of our quick survey. Thank you for those to respond. Slightly more than half of the audience own their buildings, and the rest are tenants. We do have one person that owns 3 and leases 4. So we're going to need to talk to that person about their experience since they're on both sides. Okay, so here's some additional factors. We'll quickly run through this. Where are we in the real estate cycle? The market's been very good since the downturn of 2008, 2009, as you might expect. What goes down must come up. What goes up must come down. And if I really was that good at forecasting the future, I would probably be at the horse race track today and not speaking to you. I don't know when we're going to have an adjustment. Everybody talks about it, whether it's real estate or stocks. And yet every month it seems like we're reaching new highs. The amount of money that is available for investment in the real estate market seems to be never ending, both domestic and foreign. The alternative for folks to invest in the stock market, some people are not comfortable with the stock market. The idea that the interest rate cycle may be on an increase may have an impact on real estate values. If you look back over time, it seems like there's a correction every 8 to 10 years. And we're in uncharted waters, though, with all of the drama that's happening internationally. We certainly have enough political issues in our own country, and all these play into where are we in the real estate cycle. I think the one mantra that I go by is, if there is a piece of property that you want to buy or lease and it fits your needs and it's in a good location, I would say that you should be aggressive to get control of it, because if you don't, somebody else will, and well-located real estate should always do well, whether you're the owner or as a tenant. For those of you who are thinking about selling, for the last 6 months, 9 months, 12 months, we've been telling folks, gee, the market seems pretty good right now. There's a risk that interest rates might increase that may impact the rate of growth of your real estate. So it's not, if you're interested in selling, now may be as good a time as any. Tom, where do you think we are in the real estate cycle?
I think we've already hit the top, and I think we are going down. Not like in a very dramatic fashion, but if you look at the inputs into the real estate market, you have the debt markets, you have the stock market, which influences capital flows, and we are looking to invest money at a spread, and that spread is narrowed significantly. So as it relates to operators, I feel like the cost of capital will continue to go up because our cost of capital is going up. So I feel like if there was a time to explore a sale right now, I think that now would be a very good time to explore it, because rates are still at a very good level, and they're only going to go up from here. And people who are deploying capital, it's becoming more expensive for them to deploy capital over time. So I feel like we reached the peak about a year ago, and I feel like at this point in time, you're going to see it be a little bit more difficult to raise capital in the real estate space, because values have gone up really high. So if I were an operator sitting on a portfolio of real estate right now, I'd look at a couple of different inputs. I'd look at interest rates. I'd look at the availability of providers that are out there. And I feel like now is a really good time to think about it, to monetize it, and to lock in a very low rate long term.
You see, we've got 2 people and 2.5 opinions. So there's It's one of those things you can't put your finger on it. I do think that we have enjoyed peak values. The fact that that the Federal Reserve raised interest rates last year and into this year, many of the experts said that the rate of return, the cap rates on real estate would increase. We haven't really seen a dramatic increase, but it's hard to argue with, and the dramatic increase in cap rates would imply then a reduction in price, since price and yield work in opposite directions. It's hard to argue with what Tom was saying. I don't think we've seen it manifest all the way around.
Agreed.
But
I think it's coming. I don't think it's there yet. I think that we're at peak value right now. I totally agree with Mike on that. But I think that you're going to start seeing some adjustments. And we still make a fair return in our space. And it's a much better investment opportunity than the stock market. So I think that's why cap rates have remained steady. But any additional interest rate increases, I think it's going to really hurt us. And it's going to make it more difficult for us to provide capital at very high values at very low rates. So I think it's a really good time to consider this. And you could line up all the economists in the world, and they'd go from the Atlantic to the Pacific, and you still wouldn't come up with an answer. So right. Everybody's guess is as good as mine, but I really think that I just, based on what I'm seeing on a daily basis, I think the real estate cycle is slowing a bit.
I think that if you're in a tertiary location and not near a metro area, you will be affected far sooner than if you're in a major metropolitan area in a newer building.
Absolutely.
All right. Well, let's move on. So we talked about interest rates. We talked about the political considerations. Let's talk about you and where you are. What are your business plans? Are you in the grow mode, the sell mode, the hell mode, the hold mode? And where are you in your life cycle? Are you at the beginning of your career? Are you at the end of your career? Those are additional factors that play into the decision to buy or lease or grow or hold. Okay, so you've heard us talk about the magic ratio of rent to revenue. And so just as a reminder here, we want to refresh folks that typically we feel that the rent expense should not be greater than 15% of annual revenue. For those people who are owners, we can discuss separately with you a standard ratio for mortgage expense. The concept is the same. Mortgage debt is available through SBA and traditional banks. For those customers, we've talked to many customers who complain about the SBA process, and it is a torture process. However, there is financing available if you're willing to jump through the hoops and deal with the government bureaucracy and some of the strange rules and regulations that come with taking public money. Personal guarantees will be required of you, just as we discussed before. Now, Tom's group is a REIT, which stands for Real Estate Investment Trust. So they take public money, they sell stock, and they use that stock to invest in real estate. So their approach to some of their sale-leasebacks is a little bit different. Tom?
Yes. Really, we have less limitations than the SBA. It's a much easier process to provide us with what we need to get from making an application to agreeing to terms to getting approval. I'd say it's typically about a 15-day process from when we agree to terms to when we get a financing approval. And during that time period, we're evaluating credit, we're evaluating the real estate economics of the deal, and then I'm making a presentation to my committee to get your deal approved. So it's a really easy process. I can walk down the hall and talk to my CEO about a deal, whereas at the SBA, there's a lot more regulatory hurdles and procedures and protocols in place that kind of hinder their ability to move quickly and provide you with accurate feedback.
Right. So this is sort of our disclaimer page. Remember to talk to your accountant and your lawyer about your specific situation. The tax benefits of owning we briefly touched on, and as Tom mentioned, lease payments are deductible when calculating both your tax liability and your profits. We're not going to spend a lot of time on that one. So now we're going to get into some, how do you use this information and some advanced strategies here. So the next couple of slides discuss some of Tom's approach to dealing with your real estate entity, and I'm going to give the microphone to Tom to go through these slides. Tom, when you're ready for me to click to the next one, let me know.
Sure, happy to, Mike. So we've kind of briefly touched on a number of different of these situations, and I think we'll go a bit more into detail with them. But with growth capital, basically what we're doing is we're providing you with 100% of all the costs that are associated with real estate. So, if you want to build a new site, we can go in, buy the land, pay all the soft costs, and pay for the site work, the shell, and all the TIs needed to deliver a finished building for you, so you can run your business without you having to invest money in the real estate. So that's kind of situation number one. Situation number two is if you're looking to buy a competitor, and the competitor owns real estate, we can agree to step in and close on the real estate with you in conjunction with your acquisition of the business. And this helps you to reduce the size of the equity check you need to buy a company. And it also helps you to lock in long-term flexible financing to where you don't have to find new forms of financing for that piece of the capital stack during your whole ownership period. And another situation that we can help in is if you own a piece of real estate, we can provide you with sale-leaseback financing, whereby Mike would bring us, the property. We would evaluate it and execute a new financing where we could provide you with money you already invested in the TIs as well. So real estate's a capital-intensive piece of your balance sheet, and we can provide you with solutions in many different ways. Remodeling comes into account on properties we already own with you. Let's say we execute a deal today and you come back to us 5 years later and say, hey, Tom, we really want to add these amenities for our customers. We want to increase the size of the playground. We want to add a new wing because we're doing so well, we're busting at the seams, and we can do more business here. Well, rather than cutting the check yourself, you can come to me and use our money, and we just increase the size of the building and the lease payment to cover those costs. And typically, if you're doing a deal for one-off landlord, they're going to want you to use your own capital to do this. And using your own equity capital to do projects like this to improve somebody else's property is very expensive and not accretive to you and your business. So those are kind of as a high-level overview of those 4 points. Happy to ask any or answer any questions on any of them.
Okay, let's go on to the next page.
Sure.
Go ahead, Tom.
We've really talked a lot about the benefits of working with us as a single landlord, about how we can be more flexible to you and how we structure into our contracts various clauses and benefits that you can't get from somebody who you're just leasing one property from. Substitution rights touches on the situation where if we do a deal together and the school that you are operating, or one of the schools that you're operating within our lease with you, is not working out, we can make it to where you can take that property out of our lease with you and substitute it for another property where you're doing well. So this helps you to shut down underperforming locations, because if you're not making money in a property that you're leasing from us, then we don't want you to be obligated to lease from us there, because we want you to do well with wherever you're leasing from us. Tax efficiency. We have a couple of different ways to address certain tax situations. We have a vehicle called the hybrid lease, where we buy the land underneath your building, and then we provide you with a loan on your improvements. So you have limited depreciation recapture and capital gains tax liability if you depreciated your building down to about a zero basis. So in situations where you've owned real estate for a very long time, or in situations where there's been significant amount of appreciation where there's a lot of tax leakage, we tend to utilize creative structures to provide you with the same amount of proceeds, but on a net basis, you make more because you pay less in taxes.
And we have, for the audience, we have executed on several of those hybrid leases with store. Again, we ask that you don't bombard Tom with your particular situation. That's what we're here for, and then we will be able to help navigate the roadmap there. So let's jump to some of our case studies here. So this is a typical situation that we hear from our customers, that there's a in-home center, you're doing well, there's the ability to move into a new building. The question is, should they buy that building or should they lease the shopping center space? So again, what we're trying to provide for you is the factors that go into that decision. They're both your own personal factors, your business factors, and the macro factors. And the pros and cons are evident from our discussion earlier that as an in-home center operator, Julie may not have the sufficient amount of capital to go out and buy her own building. A lender may not be willing to loan her money as she's just coming out of her home. The opportunity to be a tenant is a low-risk method for her to get going on moving out of the home and into a commercial setting. And now, some of the facts that are silent here, for example, we don't know whether she has a rich uncle who could buy the building, or she has some other balance sheet resources to buy the building. I purposely wrote this so that some of the information is unknown. My general sense is, in this particular case study, Julie is better to lease the shopping center space. Tom, do you have a quick comment on that one before we move on?
Yeah, I mean, this is Julie's first store. I think that as she grows her business, she should look to grow it conservatively. She's moving out of her house into a new space. A short-term lease that allows her to test out the new format, I think is the right way to do it, personally. And then, as her needs grow and she increases the size of her enrollment, then we look at talking about a larger situation solution, where we may be able to provide us a financing solution.
Thank you. Okay, so now our case studies get a little more involved. So Lori operates 2 centers. She wants to expand. Here she rents both buildings from the same landlord, and that landlord would like to exit the real estate business. She has sufficient family resources, but not sure whether she should sink her money into the property and control the money, or use the money to expand to additional sites. So, to buy or not to buy, and with all apologies to Shakespeare, or to lease or not to lease. So Tom, I'll pass the baton to you, and how would you advise Lori in this situation?
I don't really see why she would want to buy those buildings when she could have a lower cost option. I think that she could come to us and we could acquire it for her. and provide her with funds to improve the building now or in the future if needed, then she wouldn't have to go through the process of dealing with the SBA and jumping through all the hoops. And so, I think that this is a situation where we definitely would want to look at the business and make sure that it could support a rent payment, which it sounds like it can. But I would love to see situations like this where we have a 2 or 3 unit operator who has 2 successful businesses that have a successful proven track record to where we could acquire from a third-party landlord a deal. So this is what we call a catch and release. And we love situations like this because we already know that they're successful businesses. We're able to develop a relationship with the operator and grow things from here too. So we do these first 2 deals together, and now we can do deals 3 and 4 really easily. So I like this type of a situation for us and think we can provide a solution.
So we at SSGA, we have encountered this situation before where an operator has a deal worked out with their landlord, and they bring us a structure where they have this option to purchase or a negotiation that is concluded, and they're looking to decide whether they want to execute on that contract or bring in a third-party investor. Mm-hmm. And many times there's some creative techniques where the price that Lori would pay to the landlord is lower than the price that the investor would pay to Lori. So there's an ability to create some arbitrage. And we also have situations where the family resources may dictate that they're looking to place their money in real estate. I have a client whose parents wanted to invest in real estate, and they were willing to buy the buildings, and they didn't want an outside investor to come in. So again, the answer to the question, should you buy or not buy, it depends on how is your business doing, what are your internal characteristics, and what is the macro market situation. All right, this one's a more complicated one. We have Daniel and Susan who've operated a large center, and we specifically talked about a large center because those buildings are generally larger and they're more appealing to institutional investors. So they are contemplating selling the business to their director, but they've also received an offer from a regional company. However, the regional company does not want to own the real estate. So there's a lot of variables floating around in here. We do have many owners who are interested in selling their business to the director for social reasons and for a reward for long work. We do see that as an exit strategy. Many times that director may not have the financial resources or the financial experience to pull that off. So Daniel and Susan are weighing the karma, the good deed of selling it to the director, but they also have the ability to sell it to a regional company. The regional company doesn't want to own the real estate, so Daniel and Susan need to figure out, do they want to be a landlord to this regional company? Well, again, this is where somebody like STORE might have an interesting solution. Tom, how would you approach that?
Yeah, I mean, I think that we clearly would want to do a deal in either situation. I think we would love to come in and do a sale-leaseback if they sell to the regional company, or if they ultimately decide that they want to sell their business to their director, but take some chips off the table. I think we could provide a solution in either case.
Yes, and we do see many transactions where the business is sold to a regional or national company, and that makes the real estate immensely valuable because the credit quality of that regional or national company is probably going to be better than a single mom and pop entrepreneur. So then Daniel and Susan could decide to keep the real estate for estate planning purposes, for guaranteed monthly income, some of those benefits that we talked about before. Now, if they don't want to hold the real estate, if they're worried about obsolescence, or they're worried about the lack of liquidity, which are some of the risks that we talked about, then Daniel and Susan may decide they would approach an investor. Hopefully they will be calling us, and we could introduce them to STORE or introduce them to other methods of selling that property because it has a credit tenant.
Mm-hmm.
Okay, so now it's time for questions and answers, and we do have one question that came in, so pardon me, I'm going to read this off my phone. We own our locations, and we have set up a holding company for the real estate. Recently, we show the centers working at a loss, but the holding company shows a profit. The setting works for us until we are looking for funding. Is this the best way to structure, or should we opt to have the center show more of a profit? A very sophisticated question. So if I understand the question correctly, it appears that you're setting up your records so that the operating business pays more of the expenses and the operating business is showing a loss, but the real estate holding company, which is receiving the rent from the operating business, is showing a profit, presumably because all the expenses of the real estate are being paid at the operating level. So if I've understood the question correctly, I think that is a common way that our clients have set up their portfolios. Your accountant may have given you some advice on loading up the operating business with most of the expenses. But as you point out, the flip side of that is when you go to seek funding and your businesses are showing a loss, that takes a lot of explaining to do. I think a sophisticated funding source, whether it's a bank or an investor, should be able to reconcile the fact that the operating business is running at a loss because you've loaded up all the expenses. So it could be a sense of additional schedules being prepared to show that the operating business really has a surplus of cash. It's just that the expenses are loaded onto the business. And if hopefully I've understood that question correctly. Tom, do you have comments on that?
Sure. So the OpCo-PropCo structure is a common structure in family-run businesses and smaller middle-market businesses. We understand it, and our solution to evaluating companies that have taken this route is to consolidate the financials and to look at them as one company. So we understand why you would do that, and it makes sense for a lot of people to take a majority of your profit out through the real estate lease payment. But when we evaluate the financial health of a company, we consolidate both the PropCo and the OpCo to really understand what it looks like.
Okay, so Tom, I have a question. Let's go back to your statement before of selling the real estate before you sell the business. Our approach is a little bit different because we feel we're not able to execute the real estate piece until we know who our occupant is going to be, but perhaps I misunderstood the way you were explaining that transaction.
Sure. Well, those are two real different considerations. So what you're referring to is having the largest pool of buyers for a corporate sale and keeping flexibility on the real estate because there may be some buyers out there that want to own it or would like to execute sale-leasebacks themselves. If that's the goal, is to have the absolute largest pool of buyers, that makes a lot of sense. In my opinion, if your goal is to maximize your proceeds on the real estate, then selling it in advance and setting the rent levels to a healthy point and then selling the business with that income stream and that contract in place simplifies things. It makes it easier and a little bit less messy.
So under that scenario, you would set a lease between the occupant and the landlord, but then selling the real estate with who as the tenant, as with.
So the sequencing of it would be that your customer recognizes that they would like to sell their business, and their goal would be to maximize the proceeds both on the business sale and the sale of the real estate. So to maximize your proceeds in the sale of the real estate, you would want to figure out, what you can sell it for in advance, execute that transaction, and this is clearly, Mike's domain and advising companies on how to do this, is kind of what he does. But from our perspective, what we've seen is that you can get better results on pricing if you sell the real estate first, and then you sell the business later. Now that may lead some groups that like to execute sale-leasebacks themselves away from the deal, possibly. But we find that on a deal-by-deal basis, you probably would get a better exit multiple on the real estate piece, because you're getting a much better cash flow multiple on the real estate if you sell it and you're maximizing proceeds there. And then you say, okay, well, here's the situation. We're leasing these properties from store at X rate. That's the deal. If you're interested in still acquiring their company, that this is the contracts we have in place. We have flexible capital put in place, but we've already executed the sale-leaseback in the past.
Okay, so I think I understand that a little bit better. So you're providing some certainty and some boundaries on what the real estate is, so the buyer of the business knows what he's getting into. Mm-hmm. So that is definitely a consideration, provided that the occupant of the real estate is able to generate enough credit quality that you're going to get a high enough price in selling the real estate before you sold the business. We also have many clients who they may not have the credit standing or the desire to remain as the operator or sign up as a tenant in that sale-leaseback situation, and those clients prefer to sell the business, hopefully to a regional or national operator, and suddenly the cap rate and the pricing of that real estate becomes a lot more favorable once the investor community knows that it's a regional or national operator.
Sure. Yeah. In that case, you could clearly structure a deal in advance and, wait for the corporate sale to happen. And at that point, exit the real estate.
If it happens. Okay, last question and we'll wrap up. We promise folks to try to make this be 60 minutes. So our question here is, I have a small center and I'm leasing the building. I would like to purchase another preschool, but I don't need to own the real estate. Are there financing options to help me buy another business, particularly if it's much larger than mine? So it sounds like what this caller is asking about is if there are financing options to expand without there being a real estate component. And the answer is yes, but they will be perhaps a little more difficult since there's no real estate involved, and the ability to get financing for just the lease opportunity is going to be dependent on the ability of that person to convince their local bank to provide working capital financing for the lease. Okay. Thank you very much, everybody, for participating. If you have specific questions about your situation, we would love to be able to consult with you and help you out. We again ask, don't bombard Tom. That's what we're here for, to help digest and mold your situation and provide advice. Thank you for participating in our seminar, To Buy or To Lease, with apologies to Shakespeare. And I guess the answer is, should you buy or lease? And the answer is, it depends. please call us and we'll help you out. Thank you, everybody, and we'll look forward to your feedback. Thank you, Tom.
Thanks, Mike. Appreciate it.